Hello and welcome to our investment insights for September 2022. My name is Natalie Colley. I'm a lead advisor at Francis Financial, and we put together these presentations monthly for you to keep you informed on what's going on in the market and how we're thinking about our clients' portfolios. So let's get started with a brief recap of where the various asset classes are year to date. Well, following an unexpectedly wonderful July in which the S&P 500 returned nearly 9%, the market again took a sharp downward trend in mid-August following disappointing CPI numbers and Chairman Powell's speech in which he indicated that the Fed would continue to aggressively raise interest rates in order to get inflation under control. US bonds are now year to date down around 15%, and the S&P 500 is down around 21%. We're continuing to see US value stocks outperform US growth stocks. Value was down about 3% in August versus growth, which was down around 5%. Year to date, large cap value stocks are down around 10%, and US large cap growth stocks are down more than double that at 23%. Small company stocks are down about 22% year to date, and international stocks are down around 25%. We expect to see this volatility continue over inflation and recessionary concerns throughout the rest of the year, but it's important to always maintain that long-term outlook. And here, if we look at the long-term 3-year annualized returns, we are still continuing to see overall positive across the asset classes despite this major downward trend that we've seen year to date. The 3-year return of the S&P 500 is still nearly 8% year over year. Speaking of year over year inflation rose 8.3% for August, which is slightly below the 8.5% from July. The market fell in response as investors were hoping for slightly lower inflationary numbers, although this does bring us back to that March-April level. The Fed met this week and increased rates by another 75 basis points, bringing the current Fed funds rate to 3 to 3.25%. They also indicated that they will continue to raise interest rates up until they hit a target of around 4.5%. Obviously, the Fed hiking interest rates has a really big impact on the market, and the market did incur some volatility in response. But there are some silver linings here. As the Fed continues to hike rates, we are seeing bonds as becoming even more attractive in our clients' portfolios. Interest being paid out by currently held bonds are then being used to purchase bonds that are paying much higher interest and positioning the portfolio for stronger performance ahead. This is a welcome reprieve following bonds having the worst 6-month period in the last 40 years. It's also giving some relief to those investors who have some cash on the sideline, either for a large emergency fund or perhaps a short-term goal, such as a house down payment. We're starting to see short-term CDs and treasuries paying around 3 to 4%. Labor force participation reached its highest level of the year. High labor force participation tends to slow wage growth, which is good when we're trying to keep inflation under control. However, jobless claims fell for the 4th straight week in a row, and the tight labor market, which adds upward pressure on wages, will likely offset any reduction that we expect to see from increased workforce participation. In very good news for the vast majority of Americans who, unlike me, own a car and buy gas to put in that car's gas tank regularly, gas prices fell pretty substantially in August, down to an average of $3.82 a gallon. This was down from over $5 a gallon, which is what we saw in June. That's a decline of $1.24 per gallon. And just to put that in perspective, each 10-cent decline in gas prices equates to $11.5 billion in savings annually for Americans. So a $1.24 decline equates to about $144 billion in savings. This hand in hand with the fact that consumer balance sheets remain strong, could lead to really strong retail sales in the fourth quarter. So what does all of this mean, and how are we thinking about this data in the aggregate when it comes to your portfolio? Well, a soft landing may still be possible. Goldman Sachs reduced their probability of a recession over the next 12 months to 35%. We are starting to see some early signs of positive inflation news. Gas prices down significantly, high labor force participation. So all eyes really will be on the next CPI release, which comes out October 13th. Know that we are closely monitoring and looking for opportunities as they arise. We expect to be in a down market every 1 out of 4 years. And just as there are tactics and strategies that we employ when the market is doing really well, there are tactics and strategies that we employ when the market is not doing well. Maintaining this disciplined approach and this long-term outlook is what leads to successful investing and good long-term returns. As always, if you have any questions or concerns, please don't hesitate to reach out. Know that we are here to support you.